Hey, what's happening, personal finance class? So, we're in chapter 10. We're going to move on to the second part of the chapter, and we're going to talk all about financing a home. All right, so what are the objectives of this part of the chapter we're going to talk about? First of all, by the end of this chapter, or the end of this part of this chapter, sorry, you're going to be able to define what a mortgage is and what types are common. Second of all, you'll be able to define home equity and also explain why it is extremely important. And finally, when is it better to rent versus buying? You'll very frequently hear people say, oh, never rent, never rent. You're just throwing your money away. Um, that may or may not be true. All right. There are times when it is much better to rent versus buying. All right. So let's get right into it. Oh, there's one more. I'm sorry. And exactly how does home versus renter's insurance work, right? How do you protect your assets as both a homeowner and as a renter? All right. So financing a home. So mortgage loans, eventually in the vast majority of your lives, you're going to buy a home. So a mortgage is the term for a home loan. It's extremely similar to other types of personal loans that you'll get in your lives. It's similar to buying a computer at Best Buy. It's collateralized by the actual purchase itself, similar to buying a car, things like that. But a mortgage is a specific term that means it's a home loan. So a mortgage is actually, it is a specific legal term, and it actually is used by lawyers to actually mean that that's when the home becomes the collateral for the loan. So it's similar to other types of loans that are collateralized. What are they called again? Yes, they're called secure loans, exactly. So it is secured by the actual home, which is the underlying purchase. So typical terms, we're talking about specifically about mortgage rates. So first of all, probably the most common type, in fact, I would say definitely the most common type of a mortgage is a fixed rate mortgage, meaning it's very simple. It stays the same the entire life of the loan. You know what you're getting, you know what you're going to be paying every single month for the entire life of the loan, whether it be a 30 or a 15 year, which are the two most common types or durations of loans. So another kind, and I've had this as well, but it's called an adjustable rate mortgage or an ARM, adjustable rate mortgage, ARM. And that means the rate can change based on prevailing interest rates. It typically comes with what's called a teaser rate. Like up front, they'll say, oh, get an adjustable rate mortgage and your first 6 months will only be 1.5%, 2%, 3%, whatever. It's a very, very low introductory rate, but then it will adjust to whatever the rates are. These are typically very beneficial for lenders because in a rising rate environment, they won't be stuck with a mortgage for 30 years that's at a very low rate from 30 years ago. So they're better for banks, not always better for you. I mean, if rates go down, then it's better for you, but if rates go up, it's not. So you'll hear the term a 5-year ARM. 5-year ARM. So it has a low rate for 5 years and then it adjusts to prevailing rates after 5 years. So that's what you'll hear if you're ever shopping for a house and like, oh yeah, well the credit union down the street has a 5-year ARM at 2%. That means it's an adjustable rate mortgage, and for the first 5 years, you're going to get that 2% rate, and then it's going to adjust to whatever the rates are at the given time. So just be aware of what that means. Another type is called a subprime mortgage. And this, now there's a lot of history with these. I've decided not to get into it here. I'm really hoping we get back in the classroom and talk about the mortgage crisis. And it was a very important time in U.S. history and economics and housing. But anyways, a subprime mortgage is basically a very high interest rate mortgage that's made to a buyer with a low credit score. So someone who a lender might think might not be able to pay back that rate. So in return for giving you a loan, when they think you may not be able to pay it back, they're going to charge you a much higher interest rate in order to secure that loan, because the lenders need to get their money back. All right. If there's a chance you're not going to pay it, they're going to charge you as much as they can up front and get as much of that money back, in the short term as they can. And of course, the house is the loan is collateralized or secured by the actual house. So they're going to get your high interest payments, and then they're also going to get the house if you don't pay it back. So keep that in mind. But a subprime mortgage was a huge factor in the mortgage crisis that happened around 2008, 2010. And again, I'd love to talk more about it, but got bigger fish to fry. All right. So as a homeowner, we've talked about autos. What type of assets did we say that automobiles are, and why I said, for the love of God, don't ever take out a car loan for more than 5 years for a new car. And why is that? Yes, that's because cars are depreciating assets, but homes, on the other hand, are not. Homes appreciate over time. They are supposed to go up in value, and over the course of history, in general, real estate and homes, things like that, have gone up in value. As long as you take care of your house, things tend to just appreciate. You're not gonna, make millions, but in general, homes are good investments, and they go up slightly every year, and you get more than what you bought. Unlike a car, which depreciates in value, homes appreciate. So that gives you, or that puts you in the situation when you might actually, you have, unlike a car where you could actually owe more on it than it's worth. With a house, it's worth more than what you owe. So that means you have equity in your house. The same thing can happen with a car if you pay it down. So if your car is worth $10,000, but you only owe another $7,000, that means you have $3,000 worth of equity in your home. In your car in that example. The same thing happens with homes. But usually the house will appreciate, no matter what. And every year it'll go up, $1,000, $2,000, $3,000, just with whatever inflation is or whatever home values are doing. So you'll have this equity in your home, and you can actually take a loan out against it. So essentially, you can take a loan out saying, well, I owe $300,000 on my house, but it's worth $400,000. I have $100,000 worth of equity in my home. You can actually use that equity as collateral and borrow against it. Home equity loans are very popular in that sense. So a lot of people get personal loans by collateralizing or securing a personal loan using the equity in their home. So hopefully that makes sense. So whatever your home is worth is up here, and what you owe on it is down here. You can borrow against that difference. And you can, of course, when you secure it or collateralize it using that home equity, you're giving up your house. And you're saying, if I don't pay you back, you can take my house and sell it. So in that sense, it's a little scary, but it's a great source for personal loan collateral. So it's a good way to get a secured personal loan. So a lot of people, when they start a business, they'll borrow against the equity in their homes. And that's also how a lot of people go down in flames. Their business goes under, and then the loan comes due, their business isn't making any money, and they've secured their loan with their home equity. So then the bank has to take their home to sell it so they can get that equity back, and then they don't have a home. I think you can see where this is going. It's a never-ending cycle of having to sell everything you own to pay off what you borrowed. So these are similar to a home equity line of credit, or a HELOC. You might hear that term. Basically, a home equity line of credit is, the way that's most simple to think about it is, it's basically someone's giving you a credit card, but the amount of your, the upper limit of the debt they're willing to give you is based on the home equity or the equity in your home. So if they're like, oh, well, you have $50,000 in equity, I'm going to extend you $50,000 in credit, and you can borrow whatever you want, buy whatever, pay it back, borrow more, pay it back, buy more. It's basically like revolving credit, but you're using your home equity as your collateral for that loan. So yes, again, you can think of it as secured revolving credit. So a secured credit card. All right, so now let's talk about buying versus renting. Again, you'll hear all the time, never rent anything. You're just throwing your money away. You're giving your money to a landlord. You're not getting anything out of it. It's true. Your apartment will appreciate in value, but it doesn't appreciate for you. It appreciates for your landlord who actually owns it. So in that sense, that is true. You will not gain that appreciation. And in general, over the long term, buying is generally a better investment. You can't really think of renting as an investment. So buying a home, generally from a financial perspective, is usually better than renting. But there are a lot of things to consider. And situation by situation, it's not always better. Yes, again, not always the best option. And there are lots of things you need to consider. So let's go through what those things are you need to consider before you rent versus buy. So first of all, how long do you plan to live in the area? For example, if you're going to, go to college, it doesn't necessarily make sense to buy a house to go to college. All right. You're only going to be there for 4 years, fingers crossed. But it doesn't make sense to buy a home if you're only going to be somewhere for a certain amount of years and it's not much. If you're going for, an internship somewhere, or you're just going for, a 1-year work assignment somewhere, it doesn't make sense to buy a house. And the reason for that is there's lots of fees, lots of commission, lots of taxes and things like that come into buying a house. And those take a long time to recover. So thousands and thousands of dollars it will cost you to buy a house on top of whatever the house is worth. And it's not like the house is going to appreciate and be whatever, be valued at whatever you paid for it, including those fees. So if you're not planning to live somewhere for, a significant amount of time, it may very well not make sense to buy a home. It might make best sense to rent. Second of all, and this is a big one, especially nowadays, do you have money for a down payment? Most lenders won't talk to you unless you have at least 10% to put down. And depending on the cost of the home you want to buy, that can be extremely significant. You want to buy a $500,000 house, that means you need to have at least $50,000 in cash saved up. A lot of people can't do that. A lot of people don't do that. So you have to consider that as well. If you just don't have the cash, buying may not be possible. Forget smart versus not smart, but it may just not be possible. It might not be an option. And the more typical number they want, especially nowadays, is 20%. Back when I bought my first house, I didn't have to put $1 down, but it was a different time. That was before the mortgage crisis, and that's before lenders stopped making loans like that. So think about that same $500,000 house. You need to have $100,000 in cash in order to buy it if the lender's requiring 20% down. So another reason or another result from not having that down payment is you might have to pay what's called PMI, or primary mortgage insurance. Because, of course, when you buy that house, you're borrowing money to buy it. So the bank owns that house. And if you don't own enough, if you don't have enough equity in that house, if you haven't paid a significant dollar portion down up front, the lender is going to require that you pay insurance. And it's called PMI, and I know people who still pay it. It's not great. It's hundreds of dollars a month. It can be $200, $300, $400 depending on how much your house costs. it sucks. So if you can't make that down payment, but you can still get a loan, that's great. You're getting the appreciation of the asset, but you're paying a lot for it. Of course, what's the price of buying versus renting in whatever area you want to live? All markets are different. Some places have a booming condo market for single people buying homes. Some people, multifamily homes. The prices are very high or low. It really depends. So understand what the pricing is. It might be much cheaper to rent versus buy. It really depends on the local demographics, and everywhere is different. And a lot of that has to do with not just popularity, but availability. I mean, a lot of places just don't have a lot of, I don't know, single family homes or a lot of condo complexes, and if there aren't many, they might be selling for a lot more. If there are a ton of them and then demographics in the area change, they might be really cheap. So understand what things are relative to one another. Another thing to consider: are housing values increasing in the area? And again, this is place by place. For example, San Francisco has some of the highest real estate costs, not only in the United States, but in the world. Um, I mean, a tiny little single family house can cost, $1-2 million. It's insane. And that's mainly based on the job market. I mean, that's where all of the big tech firms and the job market there is crazy. However, look at a place like Detroit. In Detroit, Michigan, I mean, a lot of the buildings in the cities are foreclosed, and there's not even any businesses in the skyscrapers. A lot of times, it's not a good situation. So things are going to be really cheap, and they're cheap because people don't want to be there. So you got to consider that. Are prices going up, values going up, or values going down? And you can see that year over year just based on some simple research on even just Google. And of course, it's better to rent if you think that the homes are losing value, or if you know that homes are losing value. It might be a good call to just rent something in the short term. Finally, do you know enough about the area? I mean, when I moved to Grafton, we were very, very specific. I mean, it's the second home we had bought. So we knew what we wanted. We knew what we were looking for. We had some major things we were looking for. One, it had to be close to the train station because I was still working in Boston. Two, it had to have good schools because my oldest was turning 6 and going into first grade. So we wanted a good public school system. And then finally, it had to be affordable because, I mean, you can hit those first two, criteria pretty easily, but then you're in, Weston and you're in Hopkinton and you're paying, $700,000 for, a house that we can buy in Grafton for $400,000. So you need to understand the area, know what you want. And even more specific to that, I mean, what about crime? What about things like that? Proximity to where you want to work, public transportation. You need to understand these things. What are taxes like? Taxes are a huge, huge factor. I mean, some towns, for example, when we lived in Braintree, I mean, we had a nice home in Braintree, but they had a huge, what's called a commercial tax base. There was a big mall, so a lot of businesses were paying a lot of taxes. So I think our annual taxes were around $4,000, so which is not that much. However, here in Grafton, it's closer to $10,000. So that's huge. I mean, $6,000 difference over 1 year. That's another $200 a month. So you got to keep these things in mind as well. All right, and finally, last thing we want to cover in this chapter: homeowners and renters insurance. Of course, as we discussed in the insurance chapter, you own a home. You really don't own the home until you make your last payment and you get the deed. Same thing with a car. The bank owns that asset, and they are going to require that insurance be taken out on that asset. So basic homeowners insurance covers things like natural disasters, other property damage. Talk to Wag sometimes about the trees that have fallen in his home. The trees have fallen on his cars and on his house. Um, Thankfully, that sort of stuff is all covered by basic homeowners insurance. Another thing it covers is liability. So, for example, if your kids are playing and one of them gets hurt, or strike that, kids have friends over, one of the other kids gets hurt, your insurance covers any sort of injuries that happens to them. But renter's insurance is something that very often goes overlooked. Renter's insurance covers your belongings if they're stolen or damaged in natural disaster, things like that. I would say the majority of people do not. The majority of renters don't get renter's insurance. There's sort of a belief that, oh, no, the building owner has insurance, so I'm covered. No. The insurance that the owner has on the house or the apartment complex only covers their asset, which is the structure itself. It does not cover anything that belongs to you. The owner of your rental property can't claim your belongings if they're damaged. They don't belong to him or her. So if something happens and there's a fire, you're screwed. I mean, whoever owns the complex and they have insurance, they're going to be fine. Whatever you have in your rental place, it's gone if you don't have rental insurance, and you're not going to see any. You'll see absolutely no benefit from any sort of insurance that the homeowner or the rental owner, will hold. So keep that in mind. Their insurance covers their assets, not yours. And whether you're talking about home or rental insurance, policies vary. They vary greatly in what they cover and how much. So pay attention. If there are certain things, some people have a lot of collectibles, memorabilia that may or may not be covered. So you need to make sure that it is. If there are specific things, like when we got ours, my wife has a wedding ring that we wanted to make sure was covered. So we listed that specifically in the policy that said, wedding ring valued at whatever. So you need to pay attention to the fine print and make sure that the assets that you have are properly covered by whatever insurance you choose to buy. So yes, review it carefully. Before you sign and buy insurance, make sure it covers the things that you're hoping it does, right? So that's the thing. Don't hope, verify. All right, so what did we cover? What are the major things that we want to make sure that you got out of this part of the chapter? So first of all, what's a mortgage? What types of mortgages are common? Second of all, what exactly is home equity and why is it important? And when is it better to rent versus buying? And finally, how does home versus renter's insurance work? All right, great. So went through that kind of quickly. Hopefully this works for you guys. I'm interested in hearing what you guys think about this stuff. But make sure you're checking Classroom. I'm going to put other stuff out there. I think I'm going to put a math assignment out there as well. So with that said, hopefully this is working. Let me know if it is or is not. But I'll talk to you guys soon. Thanks.